My friends, history rarely announces itself when it's being written. But January 2026 will be remembered as the moment the technology industry's quiet dependence on physical commodities erupted into open warfare. On January 13th, two of the world's most powerful corporations, Tesla and Samsung, engaged in a procurement battle that exposed the fragile foundation beneath the entire electrification revolution. The prize was 85 million ounces of physical silver. The stakes were nothing less than control over the future of transportation, energy storage, and artificial intelligence. Available market evidence suggests Tesla secured significant physical supply, while Samsung was unable to obtain comparable volumes. If accurate, this outcome represents more than a typical corporate procurement success. It represents a fundamental shift in how technology giants approach resource security in an era where digital innovation remains completely dependent on physical materials. More importantly, this event signals that silver's trajectory toward the $120 level appears increasingly likely when viewed through current supply and demand mathematics that no amount of paper trading can overcome. Quick disclaimer, because this matters, this is not financial advice, this is market structure education and macro analysis documenting unusual price behavior and what it might reveal about underlying stress. I'm not telling you to buy or sell anything. I'm not recommending positions or strategies. I'm not claiming I know with certainty what caused yesterday's move. Do your own research and consult qualified professionals before making investment decisions. To understand why this battle occurred and why its implications extend far beyond two companies, we must examine the structural transformation that silver has undergone over the past 18 months. What was once treated as a precious metal with modest industrial applications has become the single most critical material bottleneck in the global transition to electrification and advanced computing. The story begins not in January 2026, but in the systematic policy decisions and market developments that created the conditions for this confrontation. Throughout 2024 and 2025, silver markets operated under a persistent structural deficit. Annual mine production consistently failed to meet industrial demand, with the gap filled by above-ground inventory drawdowns and recycling. This imbalance was manageable as long as inventory levels remained adequate and supply chains functioned smoothly. However, multiple converging pressures transformed a manageable deficit into a critical shortage. The first pressure came from the solar energy sector. The global acceleration of photovoltaic installations, driven by climate commitments and energy security concerns, dramatically increased silver consumption. The adoption of TOPCon solar cell technology in 2025 made this worse. Unlike previous generation cells, TOPCon technology requires approximately 50% more silver per panel to achieve its superior efficiency ratings. Solar manufacturers found themselves competing directly with other industrial consumers for a finite metal supply, pushing demand beyond what incremental mine production could satisfy. The second pressure emerged from the electric vehicle revolution reaching true mass market scale. For years, automotive silver demand remained modest because electric vehicles were luxury products manufactured in limited volumes. By 2025, this changed. Established automakers committed to full electrification timelines, Chinese manufacturers flooded global markets with affordable EVs, and the race toward 800-volt architectures intensified. Each of these developments increased per-vehicle silver content significantly. The third pressure came from artificial intelligence. The explosion of AI development in 2025 created unprecedented demand for high-performance computing infrastructure. Data centers housing thousands of GPUs require massive electrical systems operating at extreme power densities. Silver's unmatched thermal and electrical conductivity makes it indispensable for managing the heat and signal integrity challenges these systems present. Companies like NVIDIA, Microsoft, and Tesla itself needed more silver just to build the computational infrastructure supporting their AI ambitions. These three demand vectors, solar, automotive, and AI, converged in 2025 to create consumption levels that exceeded mine supply by hundreds of millions of ounces. The deficit could only be filled by draining above-ground inventories held in vaults and warehouses globally. By late 2025, visible silver inventories on major exchanges began declining at unprecedented rates. COMEX stocks, which had peaked at over 400 million ounces in 2020, fell below 250 million. Similar drawdowns occurred in London vaults. These inventory movements signaled that industrial consumers were shifting from purchasing silver on spot markets to building physical stockpiles. The era of just-in-time commodity procurement was ending. Then came the policy shock that transformed silver from scarce to strategically contested. On January 1, 2026, the Chinese government implemented comprehensive export controls on silver. The new regulations required government-issued licenses for any international shipment of silver, whether in raw form, refined bars, or manufactured products containing significant silver content. The stated justification emphasized national security and the protection of domestic industries critical to China's technological development goals. This decision was not made in isolation. It followed similar export restrictions China had already imposed on rare earth elements, gallium, germanium, and other technology metals. The silver controls represented an escalation in resource nationalism, directly challenging the West's assumption that global commodity markets would remain open regardless of geopolitical tensions. For companies dependent on complex international supply chains, China's move created immediate crisis scenarios. China is not just a major silver producer, it's a central hub for processing, refining, and manufacturing intermediate products that incorporate silver. Even silver mined in other countries often passes through Chinese facilities before reaching final consumers. Export controls therefore affected not just Chinese silver, but global silver flows. U.S. agencies and policy discussions within days suggested a shift toward treating silver as a strategic material. On January 7, 2026, silver was formally added to the critical minerals list maintained by the U.S. Geological Survey and the Department of Defense. This designation acknowledged that silver's availability directly affects national security, defense systems, renewable energy infrastructure, and advanced technology manufacturing. The designation carried implications for domestic mining incentives, stockpile programs, and trade policy. By mid-January, the global silver market had fractured into multiple tiers. There was the paper price, the number displayed on trading screens, derived from futures contracts traded on COMEX and over-the-counter markets. Then there was the physical price, what companies actually paid to secure real metal for immediate delivery. The spread between these two prices widened dramatically. While COMEX futures might quote silver at $85, companies seeking large quantities of physical metal for prompt delivery faced premiums of $5, $10, or even $15 per ounce above the screen price. This appears to have been the market environment in mid-January, when several large industrial companies were seeking exceptionally large volumes of physical silver. For Tesla, the motivation was existential. The company's entire product roadmap for 2026 and beyond depended on stable access to silver in quantities that most observers would consider extreme. The most immediate driver was the Model 2, Tesla's long-promised $25,000 electric vehicle designed for true mass-market adoption. This vehicle represents Tesla's attempt to move beyond the premium and mid-market segments to compete directly with affordable internal combustion vehicles globally. The Model 2's business case requires production volumes in the millions of units annually, with margins tight enough that any supply disruption or cost spike could render the entire program unprofitable. The Model 2's electronic architecture is silver-intensive by necessity. To achieve the required efficiency in a low-cost chassis, Tesla designed the vehicle around an 800-volt system with advanced power electronics, extensive sensor arrays for driver assistance features, and a thermal management system capable of supporting fast charging. Each of these systems relies on silver's unique properties. Tesla's internal analysis identified silver supply as the single greatest risk to the Model 2 launch timeline. If silver availability or pricing became unfavorable during the production ramp, the entire program could face delays or cancellation. Securing 18 months of silver requirements in advance was not conservative planning. It was recognition that the spot market could no longer be trusted to deliver when needed. Beyond the Model 2, Tesla's broader ecosystem depends on silver across multiple product lines. The company's energy storage business, manufacturing Megapack and Powerwall systems, requires silver for inverters and control systems managing electricity flows. The planned robotaxi fleet, with its redundant sensors and computing systems, needs silver-based components for reliability and performance. The Optimus humanoid robot project, which Elon Musk described as potentially more important than Tesla's vehicle business, contains thousands of electrical connections, where silver's conductivity and durability are essential. Then there's Tesla's artificial intelligence infrastructure. The company operates one of the world's most powerful supercomputers, Dojo, designed specifically for training neural networks that power Tesla's full self-driving system. Expanding this capability requires additional computing clusters, each consuming silver in high-speed interconnects and thermal management systems. When these demands are aggregated, 85 million ounces begins to appear reasonable rather than excessive. That quantity represents approximately 2,640 metric tons of silver. If we assume Tesla's annual silver consumption across all products and infrastructure reaches 50 to 75 tons, a conservative estimate given planned production volumes, then 85 million ounces provides roughly 18 to 24 months of security. Based on industry sourcing patterns, any successful acquisition of that scale would likely have required multiple channels operating in parallel to minimize market impact and maximize success probability. The company negotiated direct offtake agreements with primary silver miners, securing future production at prices established before the January price spike. Companies like First Majestic Silver and Endeavor Silver, which produce silver as a primary product rather than a byproduct, became critical partners in Tesla's supply security strategy. Tesla also conducted large over-the-counter transactions with financial institutions, private holders, and commodity trading houses willing to sell physical silver outside public exchanges. These deals kept Tesla's purchasing activity relatively hidden, preventing the market panic that would have occurred if all 85 million ounces had been purchased through COMEX, causing visible inventory to collapse overnight. Finally, Tesla withdrew physical silver from vault storage, taking delivery of bars held in custody accounts and arranging secure transportation to facilities where the metal could be processed into the forms required for manufacturing. This physical withdrawal contributed to the dramatic inventory declines observed across major storage facilities in January. Tesla's advantages in executing this operation went beyond financial resources. The company's vertical integration strategy, where it controls more of its supply chain than traditional automakers, provided relationships and leverage that proved decisive. Tesla maintains direct partnerships with mining companies, operates its own refining and processing capabilities for battery materials, and has established logistics networks for moving raw materials globally. This infrastructure could be rapidly deployed for silver procurement. Additionally, Tesla's operational presence in key jurisdictions, particularly Texas, where the company relocated its headquarters, and Australia, where it sources lithium, provided political and logistical advantages in securing supply from allied nations outside Chinese control. Samsung's attempt to acquire the same quantity of silver was driven by an equally compelling strategic imperative, but the Korean giant approached the market from a position of relative weakness. Samsung's silver requirement stems from its development of silver-carbon all-solid-state batteries, which the company views as the technology that will define energy storage for the next decade. These batteries replace the liquid electrolyte found in conventional lithium-ion cells with a solid ceramic or polymer electrolyte, offering significant advantages in energy density, safety, and charging speed. The breakthrough in Samsung's design involves the anode layer, which uses a composite of silver and carbon to prevent dendrite formation, the growth of metallic structures that can pierce battery separators and cause short circuits. By incorporating silver into the anode structure, Samsung achieved energy densities exceeding 500 watt-hours per kilogram, roughly double what current lithium-ion technology delivers. This performance would enable electric vehicles with ranges exceeding 600 miles on a single charge, charging times under 20 minutes, and battery packs that are smaller and lighter than anything currently available. The problem is silver intensity. Estimates suggest that each 100 kilowatt-hour battery pack, typical for long-range electric vehicles, requires approximately 1 kilogram of silver in its anode structure. For Samsung to commercialize this technology at scale, supplying millions of battery packs annually to automotive partners like BMW, the company needs silver in quantities that rival or exceed global mine production. Samsung's planned production ramp for 2026 and 2027 required securing silver supply immediately. The company had already committed to BMW for pilot production of vehicles using solid-state batteries, with commercial launch targeted for late 2027. Failing to secure silver meant failing to deliver on these commitments, potentially losing automotive partnerships that represented billions in future revenue. Samsung attempted to procure 85 million ounces through its established commodity procurement channels, working with trading houses and attempting to negotiate with miners. However, Samsung faced structural disadvantages that proved insurmountable. First, Samsung operates under just-in-time inventory management principles designed to minimize capital tied up in raw materials. This approach works well for commodities with deep, liquid markets and reliable supply. Silver in January 2026 was neither. By maintaining minimal inventory, Samsung found itself competing for supply at the worst possible moment, when prices were spiking and physical availability was constrained. Second, Samsung lacks the vertical integration and direct mining relationships that Tesla cultivated. Samsung is fundamentally an electronics and manufacturing company, not a resource company. Its expertise lies in fabrication technology, not commodity procurement. When the market shifted from finance to physical acquisition, Samsung's traditional advantages became irrelevant. Third, and perhaps most critically, Samsung discovered that Tesla had superior leverage in key supplier relationships. Tesla's partnership with Samsung in AI chip manufacturing, where Samsung produces semiconductors for Tesla's hardware at facilities in Texas, created a dynamic where Samsung needed Tesla more than Tesla needed Samsung. When both companies sought the same silver supply, suppliers had economic and strategic incentives to favor Tesla. Samsung's failure to secure the silver it needed has immediate implications for its solid-state battery roadmap. The company now faces uncomfortable choices: delay commercialization until silver supply improves, reduce the silver content in its battery design at the cost of performance, or pay significantly higher prices for whatever silver becomes available on spot markets. None of these options are attractive. Delay means losing first-mover advantage to competitors. Design changes risk, undermining the technology's competitive edge. Spot market purchases at elevated prices could make the entire program unprofitable. The Tesla-Samsung battle illustrates a broader transformation in how technology companies approach commodity markets. For decades, these companies assumed that raw materials were essentially infinite. Commodity prices might fluctuate, but physical availability was never a constraint. Procurement departments optimized for cost and inventory efficiency, not security of supply. This assumption worked in a world where technology consumption of industrial metals represented a modest fraction of total demand. As long as tech companies were small players in commodity markets, they could rely on spot markets to meet their needs without significantly affecting price or availability. That world no longer exists. When a single technology company requires silver in quantities measured in tens of millions of ounces, comparable to entire national economies' annual consumption, commodity markets cannot absorb this demand without structural disruption. The financial instruments that allowed price discovery and hedging when physical demand was modest become inadequate when industrial users need actual metal in unprecedented quantities. The divergence between paper and physical silver markets reached critical levels in January 2026. COMEX silver futures contracts represent claims on silver stored in approved vaults, but the relationship between paper contracts and physical metal has become increasingly abstract. Market analysts estimate that the total paper silver outstanding, all the futures contracts, ETF shares, and unallocated accounts that represent claims on silver exceeds physical silver available for delivery by ratios of 100 to 1 or higher. This fractional reserve system works as long as most claimants never demand physical delivery. But when companies like Tesla insist on taking physical possession, the system's fragility becomes apparent. There simply is not enough metal in vaults to satisfy all the claims if a significant percentage of holders demand delivery simultaneously. This dynamic explains why the physical premium, the additional cost for immediate delivery above the screen price, reached unprecedented levels. Companies willing to accept paper claims or defer delivery could transact near the COMEX price. Companies demanding physical silver immediately paid substantial premiums. Tesla's willingness to pay these premiums and execute through multiple channels simultaneously ensured the company got the metal it needed, but also exposed the gap between financial market prices and physical market reality. To understand why silver reached $91 per ounce in mid-January and why $120 appears increasingly inevitable, we must examine the metal's unique position in the periodic table and the global economy. Silver possesses the highest electrical conductivity of any element, higher than copper, higher than gold. It also possesses the highest thermal conductivity of any metal. These properties are not matters of engineering preference or cost optimization. They are fundamental physics. No amount of materials science innovation can make another element conduct electricity or heat better than silver. In applications where electrical or thermal performance is critical, silver becomes irreplaceable. Engineers can sometimes substitute copper for silver if they accept performance losses and additional system complexity. But in systems operating at the edge of physical limits, 800-volt automotive systems, high-frequency signal paths and advanced computing, concentrated solar thermal systems, silver's advantages become decisive. The electronics industry has spent decades attempting to reduce silver consumption through thrifting, using less silver per component through more precise application methods. This effort achieved significant success, reducing silver content in many applications by 30 to 50%. However, thrifting approaches hard limits. Below certain thicknesses, silver layers become unreliable. Below certain quantities, contact resistance increases and failures occur. The technology applications emerging in 2026 are pushing back in the opposite direction, requiring more silver per unit to meet performance requirements. Consider the 800-volt automotive architecture that Tesla and other manufacturers are adopting. Higher voltage enables faster charging and more efficient power delivery, but it also increases electrical stress on every component. To maintain reliability and prevent failures from arcing or thermal breakdown, manufacturers must use more conductive materials in critical paths. Silver consumption per vehicle increases as a direct consequence of performance requirements. Consider artificial intelligence computing systems operating at power densities that would have been unimaginable a decade ago. These systems generate enormous heat in compact spaces. Traditional cooling approaches, airflow, heat sinks become inadequate. Advanced thermal interface materials using silver nanoparticles or silver-based phase change materials become necessary to prevent chip failures. The AI revolution is simultaneously a silver consumption revolution. Consider solar photovoltaic technology, where the industry spent years reducing silver content per panel through thinner conductive lines and alternative metallization approaches. TOPCon technology reversed these gains by requiring thicker silver layers and more complex contact structures to achieve its efficiency improvements. The industry chose performance over material efficiency, driving silver consumption per gigawatt of installed capacity back to levels not seen since earlier technology generations. These applications share a common characteristic. They represent the technological frontier. The industries driving silver demand are not mature, stable sectors with modest growth. They are the industries defining the 21st century economy: renewable energy, electrification, artificial intelligence, high-performance computing. Their growth trajectories are exponential, not linear. Silver demand from these sectors is not stabilizing, it is accelerating. Now consider the supply side. Silver mining faces structural constraints that make rapid production increases impossible regardless of price. Approximately 70% of global silver production is a byproduct of mining other metals, primarily copper, lead, and zinc. This means that silver supply is largely determined by demand for these base metals, not by silver's own price. When copper prices are strong and copper mining expands, silver production increases as a byproduct. But if copper demand softens or copper mines face operational challenges, silver supply falls regardless of what silver itself is trading at. The remaining 30% of silver production comes from primary silver mines, operations where silver is the main product and revenue driver. These mines can respond to silver prices by increasing production, but their capacity to do so is limited by geological constraints, capital requirements, and development timelines. Bringing a new silver mine from discovery to production requires 5 to 10 years and hundreds of millions of dollars in investment. Even expanding existing operations takes years of permitting, construction, and ramp-up. In major silver-producing nations like Mexico and Peru, mining faces additional challenges from political instability, community opposition, water scarcity, and aging deposits with declining grades. Production growth projections for 2025 and 2026 from these regions are modest, 1 to 2% annually, nowhere near what would be required to close the supply-demand gap. Primary silver miners operate with all-in sustaining costs that vary significantly, but typically range from $18 to $30 per ounce, depending on the operation's grade, location, and efficiency. These costs set a floor under silver prices. No rational mining company will expand production if the expected price falls below their cost of production. However, these costs are largely independent of current market prices, meaning that even if silver reaches $120, many miners cannot profitably increase output beyond their current capacity constraints. This creates an unusual market dynamic where higher prices do not generate the supply response that economic theory would predict. Silver's supply curve is relatively inelastic. It doesn't respond strongly to price changes. Demand, meanwhile, is driven by technological applications where silver's performance is critical enough that users will pay substantially higher prices rather than accept inferior alternatives or production delays. When inelastic supply meets growing, price-insensitive demand, the result is price escalation until either demand destruction occurs or new supply somehow materializes. In silver's case, demand destruction would mean abandoning technological development central to global economic priorities: renewable energy, electrification, advanced computing. Governments and corporations are unlikely to accept this outcome. New supply, meanwhile, cannot materialize quickly given the timelines and constraints in mining development. Asian guy here, and based on my reading of the data, $120 per ounce stops being a distant forecast and starts moving rapidly toward reality. Do you believe silver will reach $120 in the near future? Share your view in the comments. Technical analysis of silver's price action in late 2025 and early 2026 provides additional support for this projection. The metal broke through resistance levels that had capped prices for years, establishing new support zones in the $70 to $80 range. Fibonacci extension analysis, which traders use to identify potential price targets based on historical patterns, suggests that once silver cleared the $90 level, the next significant technical target lies in the $120 to $125 zone. Market psychology reinforces these technical patterns. As silver prices rise, they attract attention from investors and speculators who had previously ignored the metal. This additional demand, while not as structurally important as industrial consumption, adds momentum to price movements and can create feedback loops where rising prices generate additional buying interest, further supporting price increases. For industrial consumers like Tesla, $120 per ounce becomes the reference price for capital planning and procurement strategy. Rather than hoping prices will decline from current levels, prudent management assumes prices will continue rising toward this level and makes purchasing decisions accordingly. This shift in corporate behavior, from hoping for favorable prices to securing supply regardless of cost, itself drives prices higher. The events of January 2026 mark the end of an era in commodity market structure. For decades, commodity markets operated on principles established in the 19th and 20th centuries. Fungible products traded on standardized exchanges with transparent pricing and reliable delivery. Participants could use futures markets to hedge price risk, confident that physical delivery was available if needed. Financial innovation created complex derivatives, allowing sophisticated risk management without requiring physical possession. This system worked well for commodities where supply was abundant, geographically diverse, and responsive to price signals. It worked less well for commodities where supply was concentrated, production was inflexible, or geopolitical factors affected availability. Silver's transformation into a critical technology metal exposed the system's limitations when financial claims vastly exceed physical availability and major consumers demand actual metal rather than paper contracts. The silver market is fracturing into multiple distinct markets: a paper market where financial participants trade contracts for price exposure without concern for physical delivery, a physical market where industrial consumers compete for actual metal at prices that may differ substantially from paper prices, and a strategic market where corporations and governments secure long-term supply through direct relationships with producers, bypassing exchanges entirely. Tesla's 85 million ounce acquisition represents entry into this strategic market. The company is no longer participating in commodity markets as traditionally understood. It is engaging in resource diplomacy, using capital, political relationships, and vertical integration to secure physical assets critical to its strategic objectives. Other technology companies will inevitably follow. Apple, which uses silver in virtually every product it manufactures, cannot ignore the supply security lessons from Tesla's experience. Automotive manufacturers watching Tesla secure silver while Samsung failed must reconsider their own procurement strategies. Solar panel manufacturers facing competition for silver from automotive and tech sectors may need to integrate backwards into mining to ensure supply. This shift has profound implications for commodity market structure and pricing. If major industrial consumers increasingly bypass exchanges to secure supply directly from producers, exchange-traded prices become less relevant for actual physical transactions. The COMEX silver price may reflect financial market sentiment while having limited connection to the price at which physical metal actually trades for immediate industrial use. This divergence creates opportunities and risks. For producers, it offers the possibility of negotiating directly with consumers at prices higher than exchange quotes, improving profitability. For consumers, it offers supply security but requires capital, expertise, and relationships that many companies lack. For financial market participants, it creates basis risk, the possibility that hedges based on paper prices fail to protect against physical market moves. Regulators face difficult questions about market integrity and price discovery. If significant physical trading occurs outside exchanges, how do regulators ensure that reported prices reflect actual market conditions? How do they prevent manipulation when a small number of large participants control most physical supply? These are not abstract concerns. They will shape regulatory policy and market structure in coming years. The geopolitical dimension adds another layer of complexity. Silver's classification as a critical mineral by the United States signals that its availability is now treated as a national security concern. China's export controls demonstrate that resource nationalism is a real and growing force in commodity markets. As tensions between major powers intensify, access to critical materials becomes a tool of statecraft and economic coercion. Countries with significant silver resources, Mexico, Peru, Australia, Poland, Chile, suddenly possess strategic leverage they previously lacked. How they choose to allocate production, through market mechanisms or through political agreements, will affect which nations and companies can access the material needed for technological development. Resource diplomacy may become as important as technological innovation in determining competitive outcomes. For Tesla, the successful acquisition of 85 million ounces of silver represents more than procurement success. It demonstrates the company's evolution from an automotive manufacturer to a vertically integrated industrial power capable of securing the physical resources necessary to execute its strategic vision. While competitors focus on design, manufacturing efficiency, and software development, Tesla recognized that controlling raw material inputs would become a decisive competitive advantage. This realization, that in a world of digital technology, physical resources remain the ultimate constraint, may be Tesla's most important strategic insight. Software can be copied, manufacturing processes can be reverse engineered, but access to materials in sufficient quantities at manageable prices cannot be easily replicated. By moving aggressively to secure silver supply before competitors recognize the imperative, Tesla established a position that may prove difficult for others to match. For Samsung, the failed acquisition attempt exposes vulnerabilities in a business model based on technological leadership without commensurate resource security. The company's solid-state battery technology may be superior to current lithium-ion designs, but technological superiority is irrelevant if the materials needed for manufacturing are unavailable at viable prices. Samsung now faces the prospect of either abandoning a technology it spent years developing or securing silver supply through means that may fundamentally alter its cost structure and business relationships. For the broader market, January 2026's events serve as a warning that commodity markets are entering a new regime. The assumption that materials will always be available at reasonable prices, an assumption built into decades of corporate strategy and financial market structure, no longer holds. Companies that recognize this shift and adapt their strategies accordingly will have competitive advantages over those that continue operating under outdated assumptions. The price target of $120 per ounce is not a ceiling, but a waypoint. If current demand trends continue and supply constraints remain binding, silver could exceed this level significantly. Industrial applications emerging in 2026 and beyond, from advanced medical devices to next-generation communication systems to quantum computing, will add to demand pressure. The solar energy build-out required to meet climate commitments represents ongoing, multi-decade demand growth. The vehicle fleet's complete electrification is still in early stages, with decades of production ahead. Meanwhile, above-ground inventory accumulated over decades of modest industrial demand has been largely depleted. Future demand must be satisfied by current mine production, which is growing slowly, or by recycling, which can only recover a fraction of silver consumed in dissipative applications. The buffer that allowed markets to absorb demand spikes through inventory drawdowns no longer exists. In this environment, prices will continue rising until either demand destruction occurs or supply expands significantly. Neither outcome appears imminent. Demand is driven by technological imperatives and policy commitments that governments and corporations are unwilling to abandon. Supply is constrained by geology, capital requirements, and development timelines that cannot be accelerated regardless of financial incentives. The Tesla-Samsung battle of January 2026, therefore, is not an isolated incident, but the opening chapter in a longer story about how technology companies navigate resource constraints in an electrified, digitized global economy. The winners will be those who recognize that in the race to build the future, access to the past in the form of geologically endowed minerals remains the decisive factor. Silver has ceased to be merely a precious metal or industrial commodity. It has become strategic infrastructure, as critical to modern civilization as oil was to the 20th century. Those who control its supply will shape the technological landscape of the decades ahead. Those who fail to secure access will find their ambitions constrained by shortages of a metal that most people still associate with jewelry and silverware, rather than with the circuits that power the modern world. The price will tell the story. When silver reaches $120, it will not be because of speculation or manipulation. It will be because the market is finally pricing in the reality that this metal has become indispensable to the technologies defining human civilization's trajectory. For Tesla, 85 million ounces represents the foundation on which an empire will be built. For those who waited too long to act, it represents an opportunity lost and a lesson learned about the ultimate importance of physical resources in a supposedly virtual age. Thanks for watching. If this breakdown helped you understand what's really happening in the silver market, hit the like button and subscribe to the channel so you don't miss the next one.